An IPO stands for Initial Public Offering. It's like a coming out party for companies. When a company goes public, it means they're selling shares of themselves to the public. This is a big deal. It lets anyone buy a piece of the company. Before an IPO, a company is private. Only a few people own it. Think of a small business or a startup. An IPO changes that. It opens up ownership to anyone with a brokerage account. This all happens on the stock market. That's where stocks are bought and sold. An IPO is the first time a company's stock is available on the market. It's a chance for everyday investors to get in on the action. IPOs are exciting. They can make headlines, and they can make some people a lot of money, but it's important to understand how they work before you invest. So why would a company want to go public? There are a few key reasons. The biggest one is money. Going public raises a ton of capital. Companies can use this money to grow, they can expand into new markets, they can develop new products. The possibilities are endless. An IPO also boosts a company's profile. It makes them more recognizable. This can attract customers, it can help with hiring. It's great for business overall. And let's not forget about the original owners and employees. An IPO gives them a chance to cash out. They've worked hard. Now they can sell some of their shares and reap the rewards. Going public is a major milestone. It's a sign that a company has made it. Taking a company public is a complex process. It involves a lot of steps. But here's the basic idea. First, the company needs to hire an investment bank. Think of them as the IPO coaches. They help the company prepare for the big day. Next, they file a document called an S-1. This is like a company's resume. It tells investors everything they need to know. It covers financials, risks, and more. Then comes the roadshow. Company executives travel around, they meet with potential investors, they pitch the company's story and why it's a good investment. Finally, the IPO price is set. This is based on investor demand. On the first day of trading, the stock is available to the public. The roadshow is like a promotional tour. Company executives become salespeople. They travel to major cities. They meet with big-time investors. Their goal? To get them excited about the IPO. They give presentations. They answer questions. They paint a picture of a bright future. They want investors to believe in the company's potential. The roadshow is all about building hype. The more interest they generate, the higher the IPO price can be. It's a crucial step in the process. The IPO date arrives. The IPO price is determined the night before the stock goes public. It's based on a number of factors. Investor demand is a big one. But market conditions also play a role. On the first day of trading, the stock is available to everyone. This is when things get really interesting. If there's a lot of demand, the stock price can soar. This is what's known as a pop. Investors who got in early can make a quick profit. Of course, not all IPOs are successful. Some stocks fizzle out. It all depends on the company and market sentiment. IPO superstar, Airbnb's journey to the market. Airbnb is a great example of a successful IPO. They went public in December 2020, and their stock skyrocketed on the first day of trading. Airbnb is a popular platform. People use it to book short-term rentals. They've disrupted the hotel industry. Investors were eager to get a piece of the action. The Airbnb IPO was a hot commodity. The stock more than doubled in price on the first day. It was a huge win for early investors. A tech titan's debut, Facebook's IPO story. Facebook's IPO is another one for the history books. It happened in May 2012, and it was one of the most anticipated IPOs ever. Facebook was already a social media giant. They had millions of users. But going public took them to the next level. The Facebook IPO wasn't without its hiccups. There were some technical glitches, and the stock didn't perform as well as some had hoped. But in the long run, it's been a huge success. The upside: IPO riches and market validation. Investing in IPOs can be lucrative. If you get in early on a winning stock, you can make a lot of money. It's like catching lightning in a bottle. But it's not just about the money. An IPO is also a sign of validation. It means the market believes in the company's future. That's a big deal. The downside: volatility and risk. Of course, there are risks associated with IPOs. The stock market is unpredictable, and IPOs can be especially volatile. It's important to do your research. Don't get caught up in the hype. Make sure you understand the company's business model and financials.